Hey guys, it's Mark here, and in today's video I want to talk about whether or not you should think about refinancing your property if you have a loan. And we're going to go through the analysis, and we're going to have an exercise at the end of this video so you can test your knowledge and understanding. Alrighty, so we're going to start with a property that has a value of $1 million, and this property has a mortgage on it that was originally $533,000. So the loan to value, what lenders look at, is simply the loan divided by the value of the property. So you got it around a 53.3% loan to value. And at the time of this loan, you got a 30-year fixed loan. So the term, we're going to put 30. The rate, the interest rate that you got was 5.125%. And now to calculate your monthly payments, what you're going to do is use a formula in Excel. You will do equals PMT. As you can see here, it says it calculates the payment for a loan based on a constant payment and constant interest rate. So, for the parentheses, the rate, because we want to get the monthly payment, we're going to divide that rate by 12. It's very important to do. The number of periods, we're going to have to multiply that by 12 because there are 12 months in a year. And so our total number of periods would be 360. PV means present value. So the present value of the loan was $533,000. And then FV means future value. If the future value is going to be 0 because it's a fully amortizing loan, which means the balance will be 0 after the term, 30 years. So we don't have to put anything in for future value. So my payments are $2,902.12 every month. I'm just going to make this a positive number here by putting a negative in front of PMT. The reason why it was put in negative is because that's an outflow. We have to pay that every month. So that's why the formula does it that way. Okay, so it has been 4 years. 4 years have elapsed, and now interest rates are 4.5% annually. So the question is, should we refinance? Would we save any money by refinancing? And the way to do that is to look at, well, what is our current balance on this loan? And the way that we calculate that is term remaining is going to be equal to the 30 years minus 4. So there's 26 years that are remaining. Our rate, we already know what that is. It's 5.125%. I'm going to extend the decimal point. So we know that. We know this. We also know that our monthly payments are $2,902.12 a month. So now, knowing all of that, we can calculate current balance. What we're going to do is we're going to do the present value formula, PV. And as you can read here, returns the present value of an investment, the total amount that a series of future payments is worth now. Start the parentheses. The rate is 5.125% divided by 12. The number of periods, 26 years times 12 because there's 12 months in a year. And our payments, I'm going to make it a negative $2,902.12. Parentheses, enter. And there you have it. So the current balance after 4 years is $499,742. Great. So now, the new rate of the loan, and this is what I'm going to do here. Old and new. So if we got a new loan, it would be another 30-year fixed rate loan at 4.5%. The loan balance would be the current balance, and our payments are going to be the rate divided by 12, number of periods times 12, and the present value of around $500,000. So as you can see here, our payments are less. The difference is $370 a month less. But does that mean that we should refinance? Because even though it's less, we are going to have to pay for a longer time. We're going to have to pay 4 years longer. So the question is, how much interest do we pay? Total interest paid. Or I'm just going to say total interest here. So the way that we calculate that is we're going to do, first of all, we're going to do total payments. And your total payments are going to be simply your monthly payments times 12 months in a year times the remaining years of 26 years. So you're going to pay a total of $905,460 over the life of this loan. The total interest is simply your total payments minus the balance of the loan. So that's $905,000 minus about $500,000. We get $405,718. In this scenario, our total payments are going to be the reduced $2,532 times 12 months in a year times the 30 years that we have remaining. So you're going to pay, as you can see here, a little bit more in this case. You're going to pay $6,100 more over the entire life of the loan. And the total interest, total payments minus the current balance. And that should be the same number, which it is. So there are a lot more things that go into this analysis, which are, for example, there's fees that are involved with refinancing. It's not free to refinance, so you want to factor in what the fees are. What fees are involved in a refinance? Well, there's an appraisal. That can run you anywhere from $500 to $1,000. Let's do $750. There's loan doc preparation fees. Typically, I've seen these costs run anywhere from $1,500 total to $5,000 total. That's kind of the range that you're going to look in for these total costs, and you want to have the costs broken out to you by the lender you're speaking with, so it's all there on the table. There's no surprises that you'll have to face. Now here's a question that I would like to ask is, what rate wouldn't make it sense for us to refinance? Here's how I'm going to look at this here. I'm an investor. I'm going to hold this property for the long term. I don't plan on selling it. I'm going to hold it for the long term. So if I can save, worth my time, if I could save above $20,000, that's just me, I would be willing to go through that process of a refinance. So one way that I can do this is using the goal seek function in Excel. Do Alt-T-G. And I want to set this value to, what I'm actually going to set it to is 25,000, because I know those loan doc fees could go up to $5,000 just to refinance. And I'm going to do that by changing the rate, the interest rate. So what this is going to do is it's going to tell me what interest rate would result in a savings of $20,000. And that is a 4.2% interest rate. So I know that if rates go below 4.2%, then I would be willing to refinance. But if they don't, then I wouldn't. That's just me. Other people may have a preference. If they could save $5,000 after loan fees, they might go for that. If I think rates are going to decrease further in the future, I might want to hold off. I know that rates houses, and this is 2014 in May. I know rates went down to around 3.5%. So when your rate is 3.5%, holy cow, you're saving $100,000 about over that entire life. So you can see how this helps someone to think about whether they should refinance or not. Of course, there are other factors involved that aren't purely financial. If you think you're going to sell the house within a few years, then that savings isn't really going to be realized because you'd have to hold this house for the entire 30 years. And it probably would not be worth it because you'd pay $5,000 up front, and the savings that you'd have over those 5 years may not recoup that cost. Other things too, maybe you just want to have more money now, so refinancing, if you can save $300, that could help you make your payments. Even though you're going to be paying more over the long term, saving money now may be worth more to you if you can hold on to your house. So I said that I'd give you an exercise at the beginning of this video, and here is the exercise. I will also put a link to an explanation of refinance costs that Zillow has here that lists them all out if you want more information on that. So here is your exercise to apply what you've learned and see if you've actually understood it. Here are the original loan facts. The property value was $750,000 when you bought it. You got a $550,000 mortgage. The loan to value on that was simply mortgage divided by the property price, 73.3%. The term is 30 years, and your rate when you got the loan was 7%. So I'd like you to calculate your monthly payments of your current loan, first of all. And then, here's the question. It's been 8 years since the origination of your loan, and you are considering refinancing your house at today's interest rates of 5%. Market rates are 5%. Because you intend to hold the property long term, if you can save $50,000 in total interest over the life of the loan, you will refinance. So, in doing this exercise, these questions will help guide you to that final answer of, will you actually save more than $50,000 over the life of the loan at today's rates of 5%. And keep in mind that you'll have to think about refinance fees of $5,000. And then at the very end, I would like you to use the goal seek function, which is Alt-TG, and see what rate would result in a savings of $50,000, or in this case, $55,000 because refinance fees are $5,000. Alright, I will put an answer key for this exercise and in the attachments. And let me know if you have any other questions, comments, or suggestions for next video I should make. Thanks, guys.